Hi, I'm Ross from Smith Property Accountants, and I did a presentation last night at Waikato Property Investors, and we just did 5 simple tips and tricks that might help property investors. A few different things that we don't normally talk about, a few that you might have seen before. Yes, this video should go for about 10 to 15 minutes, hopefully more like 10. And yeah, hopefully just give you a few little things to think about with property investment. So obviously to start with, this is just general information. It's not specific advice. If you're looking at changing around properties, changing ownership, buying properties, selling properties, get some full advice, come and see me, have a proper property advisory meeting with me and get some full advice, but this will hopefully give you some really good ideas. So we've got Dan and Sue. Dan earns 14,000. Sue earns 195,000. I said this is a standard sort of couple last night. And yeah, got a few cheers, a few laughs for that. But yeah, generally what you'll find is there's generally one person who's got higher income, one that's lower income. Dan is any more income taxed at 17.5. Sue is taxed at 39%. So lots of different options. In this case, Sue has got a rental. She purchased it December 2019. It's in her personal name. It's 23,000 taxable profit. So either she's doing really well or she's not getting many interest deductions with the new rules, but making a good taxable profit. She's earning a very good income, so she's taxed at 39%. Her tax to pay is about $9,000. So that's our starting point. Then we've got, I've got 5 different things that sort of run off that a little bit more, the first couple. So the first thing that comes along quite a lot often at the moment, and we seem to be getting a run on them, is change of names. So Dan and Sue are looking at going off to the bank and they're going to borrow some more money and they're going to buy an awesome subdividable property. So the bank requires Dan's name on the title. A not so smart accountant or a mortgage broker or the banker, they go, oh, this is awesome. We can put 50% of the profit to Dan, 17.5% tax. The tax is now 6,500. We've saved 2,500 per year. Well, that's all and good, but there's a lot of problems with that. So Sue would be selling half the property to Dan. They're related parties, has to be at fair market, so you're most likely going to get a gain in value. That gain is going to be taxable. It's caught by bright line, so we end up with some tax to pay. If it's been a big increase in value, that could be a lot of tax. It could be tens of thousands of dollars, could even be in the hundreds of thousands of dollars. We're also restarting a 10-year bright line on the half that Dan is going to purchase, and we've also got loss of interest on that half. So basically, don't do that. Your banker tells you, let's just stick the other name on the title. Do not do that. Get some proper advice. And there is some ways that we can do it. One in particular would jump to my mind, whereas with good planning, we could achieve what they want to achieve with no tax, no big issues. Relatively simple and easy. And it's just about getting the advice first and working out and planning it through. There's also a thing called rollover relief as another option. To me at the moment, rollover relief is absolutely useless. It's the worst legislation I think I've ever seen. But the new legislation is due any day. Once that's through, that is meant to fix it. And I'll reread that legislation once the finals come out, because often it changes slightly, but most likely that's going to fix up some of the problems and make rollover relief a lot easier. Make it a lot easier to do that. So that would be another option that we could look at. So if you are planning things like that, get advice. Don't just make changes to titles. Next point. So I've got 5 points. This is the second one, trusts. So first thing that jumps to mind is that they're a pain. They're expensive. There's lots of hassles. Anti-money laundering is a pain. Everything takes longer and is more expensive, but they do have lots of places. They're very good for asset protection if that's important to you. And they can also be very good for tax planning, which is this point. So Dan and Sue have a son, Joe. He's 17 years old. They generally spend $14,000 on him a year. If we could change to a trust, and I'm not saying we should do that or anything like that, but if we could have this property in a trust instead, What we generally do is get trusts paying the expenses for Joe. So rather than the parents paying for extra things like overseas trips, sporting things, musical instruments and that, the trust would pay that 14,000. Then we'd look at allocating from the trust 14,000 to Joe. If he's got no other income, the tax is 10.5%. So 23,000, 14,000 to Joe, about 1,500 in tax, 9,000 to Dan. He's on a lower income, 17.5%. So another 1,500 in tax, total about 3,000 versus 9,000. So yeah, a clever ownership structure like the trust could save $6,000 per year in tax in this example. 6,000 is a lot. And that is relatively simple. We've got some clients and we've done some videos that you can see on our link tree where we can save a lot more than that. This is a relatively simple option, saving $6,000, and it shows where reviewing that ownership structure is really important. So that's tip 2, review where your profit is going. Tax. Yeah, obviously 5 years is coming up for some people, and so be very careful. Don't do an early sale and purchase agreement. If you've owned a rental property that's under the 5-year bright line for 4 years, 8 months, if you do a sale and purchase agreement now that settles 5 years, 2 months, that is taxable because the sale and purchase is within 5 years. So don't do an early sale and purchase agreement, and also make sure you check your dates. That, yeah, exactly when did it settle? Make sure it hasn't changed to a new entity or something. Double check that you've got the bright line right, because otherwise you could be in for a tax bill. So I would always just run it past your property accountant. Just double check that you're not caught. And everyone always thinks there's one way of getting taxed. That's Brightline. Well, there's a whole lot more. So another one, yeah, your personal house. Again, everyone thinks that it can't be taxed. Well, it can be taxed or it can be partially taxed, depending on when you bought your personal house. So be careful if you're selling a personal house. I would just double check it as well. I'm a property trader, I'm a property developer, I'm tainted, so that can affect it. And even though I might not be caught by Brightline, I might be caught by tainting rules. If you're a builder, you could be caught by builder rules. Generally, if you subdivide and sell, the starting point is it's taxable. There's lots of exemptions, but just start thinking, yeah, if you're subdividing and selling, be careful on tax, make sure you get advice. There's other taxing provisions as well, and there can be GST. So if you're selling a property, don't just think Brightline, get it checked, make sure you're not caught on something else. Fourth rule comes up a lot. Repairs so you purchase a rental property. It's an existing old house. You purchase it. So if you purchase it, you have no tenant and you do a renovation, any assets are going to be assets and depreciate. So you put in some new carpets, curtains, dishwasher, stove, heat pump. They are generally going to be over $1,000, and you're going to depreciate them. If they're under $1,000, and that's cost is including GST for residential rentals and installation, I would still put them as an asset and depreciate them. The reason why is any repairs. So you paint the property, you put in a new toilet, you put in a new shower, you do some kitchen cupboards, you do some other sort of little repairs, they are non-deductible because you've got no tenant. Other option, you purchase it, you tenant it, and then you renovate it. The assets, if they're under $1,000 or under, you'd use the low asset threshold and fully claim it. Anyone's over $1,000, including the installation, you would depreciate them. Repairs are fully deductible. So because you've got a tenant, if you paint the property, those repairs are going to be fully deductible. So to me, everyone goes, well, I'm going to purchase it, I'm going to tenant it, then I'm going to renovate it to get this tax deduction. I would actually go the opposite. I would purchase it, have no tenant in there, do it up, make it look great, then get a great tenant paying great rent, and unfortunately miss out on the deductions. So just something to think about. If you go the opposite, for sale, if you have a rental property for a few years, you renovate it, then you have no tenant and you sell it, again, the repairs are going to be deduction, the assets is going to be no deduction because you you can't depreciate them over the next 20 years because they're going to be sold straight away. So generally you would get nothing for those repairs. Whereas if you've rented it for a while, did the renovation, then tenanted it, then sold it, your repairs will be deductible. But just be careful with that. Again, I would take option one. I would, wait until the tenant's out. I would renovate it, do it up for sale. I would stage it, try and get my best possible sale price, and I'd miss out on the tax deductions. But again, think about your timing for your repairs for your situation. Our last tip, number 5, this is amazing how often this is missed. And it's just a simple one of getting a chattel's valuation. So you buy a brand new townhouse, you get value it in, they value the carpets, curtains, dishwasher, stove, heat pump, fences, decks, driveways, paths, all the separate chattels. And you then get a big depreciation deduction. A new property can easily be 30,000 chattels, saving you 10 grand in tax long term. And we only recommend value it. They've been around for the last 20 years or so. Do a great job. If we get an ID audit, we can actually use their information and go back to them, and they're very useful. Lots of other valuers do them, but yeah, it's always it's a short list. It's low values. I'm never that happy with it. So always use value it. And yeah, I reckon maybe 50% of property investors still don't do this. We've been going on for about the last 19 years, how long I've been running Coombe Smith for. And it's just amazing. We say it again and again and again. Number 1 tip, save tax, get a chattel's valuation. Still so many are not doing it. And you do need to look at whether it's worthwhile or not. Anything new, good chattels would be. If you're starting off with something old and completely renovating it, putting in all new things, you'd use your cost price, but worth considering. And last little thing, our Linktree, it's got heaps of great information on it. It's got webinars on it that we've run. It's got webinars coming up. Got none at the moment, just a little bit busy with the end of financial year, last minute rush. But in April, we'll put up some webinars and have some good information up there. We've got lots of old recording ones. So I'll just bring that across as the easiest way. We've got rental basics. We've got some ideas on saving money. We've done holiday homes and GST. We've done current opportunities. Are we getting enough cash from your rentals? Trust basics. There's a lot of different recordings on here. For clients, we've got some client-only subdivisions and interest limitations. Down a bit further, we've got lots of great videos. My favorite one at the moment, what's the cash flow on a new build? And it's amazing how bad that is. And if you discount it, how much you have to discount to make it good. There's another structure example about saving thousands. They're generally about 10 minutes long. So nice, short and sweet. The webinars are generally an hour. And I've also put up the link for what's a registered community housing provider. If you're looking at doing social housing, obviously you want to make sure they're actually on that link. So hopefully you enjoyed that. Hopefully you got something great from it. If you went along to Waikato Property Investors last night and saw me speak, hopefully you still got something from it, and just going through those things again, hopefully reinforce things. Cool. Thanks a lot, and we'll see you later. Bye.